welcome to our last panel of the day here in London. Thank you to all of our clients who stayed with us, many of you throughout the day, and of course to our virtual audience who is tuning in the thousands from all around the world. Before we begin, a few very quick housekeeping rules. This session will be recorded and we will be taking audience questions throughout, which means that you can pop any burning questions you might have in the Q&A box on your device in front of you. Okay, let's begin. No two energy crises are exactly the same, and this very latest one is very peculiar indeed. It has been initially driven by the global pandemic and now by a war that is raging not very far from here. So the big question that this panel will try to answer today is how has it impacted the transition to net zero? Has it completely derailed it, or has it indeed accelerated it? Well, to shed light on these fascinating issues, here with me today are Yerlan Zistikov, Global Head of Emerging Markets at Amundi, Charles de Quinzonas, Portfolio Manager, Emerging Market Debt at M&G Investments, Ben Daly, Head of Transition Finance at Standard Chartered, and last but not least, Emily Ashford, our Executive Director, Energy Analyst, also at Standard Chartered. Welcome to all of you. Emily, let's begin with you. You are an energy analyst. You look at energy on the oil and gas markets all day long. So what do you make of all of this that's going on? What has it done to oil and gas markets? I mean, prices have gone through the roof. What do you see? What's your projection?
Such a wonderfully broad question, isn't it, to start off? I think I would say the way that I expected this year to play out, and if you'd asked me in January what I thought we would be talking about now, I'd be saying we'd be talking about how we're exiting from the nuances of waves of COVID, and we're starting to look for that inflection point where we begin to price in the energy transition. That process is going on in the background, but obviously firmly in the driving seat is the situation with Russia and Ukraine. That is driving prices because it is making the market have to suddenly and very abruptly look at an energy transition on perhaps the scale that isn't the government's intention. It's also making the market consider all of the nuances of energy flows. We're looking at infrastructure. We're looking at maybe there's enough oil or energy in the market, but it's not necessarily in the right place. So extreme dislocations, not only affecting oil and gas, affecting products markets. I mean, you only need to go down the road and then try and fill your car up with petrol or diesel and see the absolutely astonishing prices that we see at the pump. This is not only a news story on Bloomberg, this is something that is hitting consumers in the pocket. It is a situation where we are also looking at impacts on food industry. We're looking at potential for global hunger issues and cost of living issues. So it's certainly been a fascinating couple of months to look at this and to try and work out what is going on. It's for that reason, I think that we have also seen extreme price volatility. One day within the last 7 weeks, we had Brent crude move to a $19 range. It's absolutely extraordinary, the movements that we've seen. At times, a market that is nearly impossible to trade. So it's been fascinating as an energy analyst to look at this. What I would say is that when we've done our analysis on the removing Europe from its dependence on Russian energy, we are able to model that it is possible to remove oil from the equation as long as we achieve a couple of conditions. And so one will be there will likely be price rises. But in order to minimize those price rises, we're looking at large strategic releases from governments, something we've already seen happen to date. We're looking at any spare capacity that exists from OPEC producers being utilized. And to some point, that also includes Iran. So we'd also be looking for some sort of deal in the Iranian nuclear agreement to try and bring that production onto the market as well. Where it gets very difficult is gas. And I think for that reason, that is potentially why discussion on sanctions from the EU has been firmly focused on oil at the moment. It is much more complicated to remove gas from the equation. Perhaps that is also in the reasons that Russia is weaponizing its gas flows to some extent. The gas situation, much more complex, much more impact on industry as well, moving down the chain. So just last summer, we had effectively had a gas crisis in Europe as well. If we're looking at a repeat of that one. One thing I think that's interesting, and I'm sure we'll come back to it later, as I said, is effectively forcing the energy transition on these governments. And in a way, Europe is acting as a test case for the promises, the various ambitious promises and goals that were made at COP last year. And we're looking at these having to be pushed through. There will be pain to consumers, that's consuming countries, consuming companies, and people as well. But it's potentially a way of accelerating that energy transition as a test case.
Okay, thank you so much. So interesting things you mentioned here, Europe being a test case, and I would like to bring you, Charles, in on the conversation now. So we all know, and you pointed it out just now as well, that Europe, of course, is trying to end its dependency on Russian oil and gas. But I wonder, how do you really make that happen? I mean, the amount of money needed to really boost renewables at a level to really make that a reality, I mean, that's enormous. So I wonder, where does the money come from?
Thank you. Thank you for the question. I think there are a couple of questions in your question. The first one is this driving a shift into the pool of capital into renewable energy in the short term? I think Emily alluded to it already. I think even though a vast majority of scientists say that the energy transition is urgent from a climate standpoint, I think it's fair to say that most political leaders and governments were quite uninterested in the topic as long as the prices of oil and gas were affordable for their people and their country. So unfortunately, we needed a shock. That shock, sadly, has been the conflict in Ukraine. And now we have shifted to this, energy security topic, which is itself helping that energy transition into renewables. As investors, this is a huge opportunity for our clients. Whilst you will see, or we are seeing in the short term, some, I would say, tactical long position into the energy sector because of high oil and gas prices. Not only renewable economics on a relative basis versus high oil and gas prices are cheaper, and this is helping us investors looking at this sector, but also from a medium to long-term standpoint, the risk of stranded assets in oil and gas is pretty elevated. So not only, on the one hand, as a sector, the renewable sector is attractive because the long-term outlook is good and it is cheaper now, but also, like I said, it's also how much money was going into oil and gas that is going into renewables. In the public bond market, which I cover, the Indian renewable sector has grown a lot on the back of that. So you had private equities getting involved. You had bondholders getting involved. And I think there is clearly an acceleration, and clearly not only have we seen an acceleration in the past 2 years, but we expect this to continue going forward. So back to what Emily said, energy security is clearly driving, the energy transition into renewables, and that will continue to drive capital into the sector.
Thank you so much. If I may, let's stay with investors for a little bit longer. Yedlan, you run Amundi's emerging market business. Amundi has been very active in the ESG space, in climate change, probably for the past decade, as far as I understand it. Yet when you and I chatted the other day, you said this is going to be a very, very difficult energy transition. So what are you seeing as an investor, and how are you helping to accelerate it, so to speak?
Yes, thank you very much. Lisa, more difficult part here, of course, apart from what Emily was saying, that we have to now spend additional money on maybe energy transition, but not exactly into renewables, but energy transition away from one geography to other geographies, which is unfortunate. And we're looking at, of course, some numbers were already there by EU saying that immediate investments to reprofile some of the infrastructure is 200 billion euros, which for the next 5 years, our analysts are looking at investments over the 10-year horizon that is needed in order to make this difficult transition for Europe of 1 trillion euros. So this money arguably could have been used for other things. Clearly, security and energy security is another drag on global spending. So this money could have been spent less on the weaponry, but more on the energy transition from renewables perspective. So this is a challenge. But broadly speaking, if we're really looking at the climate math and thinking, 1.5 degrees, and we obviously looking at the very dire report saying that in 5 years we're going to be there, which shows obviously acceleration of some of that negative trend that we have from the climate perspective. But more broadly speaking, it's when we were already having those commitments from emerging countries, including China and India, on net zero, if we were modeling that into temperature changes by the end of the century, we were at 3.2, not 1.5. So the idea was already there. It's a difficult transition. We get what we get for the moment, but let's move into that direction. 1.5 is aspirational. We may not get there immediately, but let's work towards that. So the challenge here, of course, has been from the experience in India, from the experience in China, is apart from the social aspect of that energy transition, which is going to be very costly, and funding of it. That's something that we obviously dealing with, raising more assets and more funds to facilitate that transition. It's been a lot of resistance coming from the vested interests. Let's face it, there's some significant industrialist forces in these countries which are trying to slow down that transition. And it's going to be more difficult now to make that case if we're seeing Europe saying, well, wait a second, energy transition is first. Why don't we just focus on that? So our view, and what our values are, of course, built around that view, is that this is a very temporary situation where we have a blip, where we need to redirect some of the investments for that non-productive energy transition, as I would call it, then to really have a long-term goal to achieve that energy transition, the real energy transition from the climate perspective. So that is a challenge, really, where at the moment where both asset gatherers, asset managers are taking a pause and saying, well, maybe obviously the returns also is an area where a lot of investors are taking a pause, thinking, well, we've been short maybe some of the most polluting part of the investment universe, and that has performed. Now we're talking about coal, we're talking about generally fossil fuels as an industry. So this is creating a little bit more of an issue, but on the positive side, as Charles said, the break-even for hydrogen is here now, all of a sudden. Now, it was the most expensive type of renewable energy, but obviously we had significant breakthrough earlier on solar, and which is now looks very cheap, and we have definitely see a lot of demand for investment into solar in emerging markets. But wind obviously has been there, so that's a good side of it, that it's all of a sudden at this energy energy level we have an opportunity to really invest more in renewables, because it becomes even more attractive. Mm-hmm. So the challenge here is to look through the short-term blip. In the short term, I mean, next 5 years probably, but then really drive that transition again and reaccelerate that. And that's obviously going to be the large bulk of that transition will happen in emerging countries. We know that India is looking to industrialize itself really fast. So that means that this is the area where we still need to work a lot with our Indian partners. China obviously committed, and we were supposed to see for the first time that coal production will go down in China this year, but doesn't seem to be happening this year, unfortunately, given the situation. But we will continue working in that direction and really directing more money towards those goals. And as you mentioned, Amundi has been working on this for quite some time, even 10 years ago when we launched carbon indices, and then continuing to commit ourselves with the funding for green assets in emerging markets. We're running probably the most of green assets in emerging today, thanks to some very generous support of the multilateral institutions. And this is where we really have a very good feel about that the support of our institutional investors, the support of the multilaterals is still there for the transition. That's what makes us believe that the long-term goal is still there. So we were distracted a little bit, but hopefully we will overcome those difficulties and distraction in the short term and really continue committing ourselves to the energy transition.
Sounds definitely we have a lot of work ahead of us, and you will be busy for the foreseeable future in your role. Ben, I'd like to bring you in on the conversation here. I mean, transition finance is your bread and butter at Standard Chartered. So I'd like to talk a little bit about the role banks play in helping its clients to transition to net zero. I mean, some would say that banks should simply stop financing oil and gas companies. So I understand it's complicated, it's more difficult, and that's to walk us through what are some of these challenges that are, you're facing when you talk energy transition to our clients.
Okay, so I'm going to answer that in two parts. First is how are banks, or the role of the bank, and then I'll touch on why the oil and gas sector is still hugely important and deeply relevant. So in respect of how banks are playing a role, I think there's sort of two buckets. One is very much advisory and balance sheet driven, and to give a bit of a plug to the bank, we've got $350 billion out there, which is tagged to aid the transition of the hardest to abate high emitting sectors. Now, what does that look like in practice? We as an organisation spend a lot of time supporting multinationals, but in particular in the oil and gas space, develop renewable energy companies. We're also looking at specific decarbonisation projects, so whether or not that's carbon capture and storage, whether or not that is investment into the development of hydrogen solutions, anti-flaring, that sort of project. I think I can't remember who mentioned it, maybe it was Charles, you mentioned stranded assets. We're also spending a lot of time looking at sort of M&A solutions around how do we help our clients ensure that they don't end up holding stranded assets. We mentioned coal earlier, and I think one of the risks for the oil and gas sector, and it's almost a leading indicator, is to look at some of the miners who have got coal assets which they've had to sell at a much lower than their sort of book value. So we're spending a lot of time having some M&A discussions on when's the right time to realise value in your assets. The second bucket is all around frameworks. I think this comes back to sort of access to capital and ensuring oil and gas clients, whether or not you're a super major right down to an E&P company, have access to capital in the future. And I think the kind of the significance there is under the sort of the ESG banner, the net zero banner, it's really complicated. There are thousands of different taxonomies, there's thousands of different expectations. We've got investors requesting banks to make certain actions. We've got NGOs. We had our AGM last week, a reasonable amount of noise from both NGOs and investors on our own stance. So it's helping our clients sort of navigate through this very complex web of frameworks, and the way sort of the bank plays an active role there is to the extent you're thinking about doing a transition bond or making some sort of sustainability-linked commitment to the market through one of your financial market instruments. Looking around the room, we've got a huge amount of capability sat here to sort of advise on that. So they're the two sort of big buckets on how we're supporting. Now, the more knotty question, why is the banking sector, including Standard Chartered, still committed to the oil and gas sector? I think there's two parts to this question. The world still uses an absolutely vast amount of energy. I think it's 600 exajoules of energy on an annual basis. Of that, more than half comes from the oil and gas sector. We can't just step out of the sector in an instant. So I think that's quite a sort of broad brush statement, but one I think we're very sort of aligned behind. The sector does, though, need to do more. And I think the example I would give, I've spent a bit of time in Dice in the northeast of Scotland. And if you take a sort of February afternoon, a oil and gas company has a capability of operating in horrendous weather, doing horizontal drilling in a very sort of safe manner. Their sort of engineering capabilities and the production capabilities of the oil and gas sector, including operating in emerging markets, bringing R&D through, is probably greater than any other sector that certainly I'm exposed to. Matched with that, they've also got a huge amount of balance sheet. So I think the sort of, why is that relevant? I think the complexity of the energy transition, the complexity of the technological solutions we need to create green hydrogen at a price point that actually works, to be able to develop carbon capture and critically storage solutions that, again, work at an economic basis. I spent a lot of time talking to the steel industry, talking about how do they decarbonize the steel industry. What's really interesting is that the ever-increasing number of ex-oil and gas folk who are now aiding in a more consultancy basis the decarbonisation of steel. I think it's really leveraging the expertise that sit within the oil and gas sector to decarbonise. So to sort of summarise that piece, I think the oil and gas industry is critical. We need energy. That said, it is not we can't allow it to be complacent and assume that the demand for energy means it doesn't need to make meaningful decarbonisation commitments. And I think there is a role for the financial service sector, leveraging this sort of need for capital to accelerate the transition that occurs within the sector, not just focus on the MNC or the sort of the super majors, but also some of the mid-tier guys to also start to make sure that they're doing everything they possibly can, whether or not that's anti-flaring, whether or not that's getting out of some of the more heavy oil assets, and really thinking about adding a lens, a decarbonisation lens to everything they do.
Thank you. Very wonderfully put and very insightful. We have an interesting virtual question that just came in. Thank you very much, whoever is out there and who posted us. Charles, I think I'm going to ask you this one. And it has to do with trying Europe, or like the world, but Europe in particular at the moment, trying to really become more energy independent and secure its energy security. So the question is, will that mean an increase in coal consumption in Europe? So I know that you have a very strict coal policy that you have rolled out. So how are you dealing with that increase in demand and balancing that? How are the companies that you're financing?
Yeah. Disclaimer, I'm an emerging market corporate fund manager, so on European companies, I wouldn't dare to have a view on this. That being said, you're right, the MNG has a coal policy, which actually has been implemented this month for developed markets, which include a number of European countries. I think the transition debate is very important, and when we build the policy, at the moment, the asset manager, MNG, we cannot invest in any coal exposure when it comes to equity or debt. That being said, we have a list of exemptions, and we analyze, we assess, companies based on their standalone merits when it comes to transitioning. Do they have a plan? Is the plan credible, etc.? And if this is the case, they are on the list, and we can invest in them. I'm not going to list all the various requirements for that, but it's quite ambitious, quite demanding when it comes to be on the list. So we're still quite strict when it comes to coal. For emerging markets, we, as EM investor, we recognize they need more time, because for some of them, they just don't have a plan yet, or haven't been pushed by their own government to get on a plan. So we're giving another 2 years for EM emerging markets, non-OECD countries, to basically engage. And that transition is trying to, engage as debt holder, as shareholder, and telling them, look, you have 2 years. In 2 years, we won't be able to engage if you don't come up with a plan, and then we need to assess the plan. So it needs to be credible. And I think this is the best way to do things. If I may just because coal is a big topic, but I think oil and gas is actually the next big topic in terms of restrictions across firm. And on oil and gas, we've made the choice for all our sustainability funds to exclude oil and gas. And I think Europe, if you look at the labels in Europe for sustainability funds, they actually require exclusion of oil and gas, more or less. You have a couple of years to completely exclude them. And the transition angle is also extremely important. So we have for this a different list, which is called the transition leader list, where we also do the assessment. But I think I echo what Ben just said in the sense that, yes, you can do exclusion, but you have to do it in a sensible manner and in a manner that helps company doing so. And just to finish on Europe, because I had a chat, because of the Ukraine conflict, we've had a chat about Central and Eastern European utilities, which have been impacted and with respect to receiving gas, etc., and the transition. And we are working with them. We are engaging with them, trying to see what's the plan there. We expect the bond market to be extremely important. Regulation, there's been a big regulatory push from government, but actually they're not necessarily putting the money, going back to your question on capital. And so the bond market, debt market in general, will be extremely important for utilities in Eastern Europe to finance this transition.
Thank you. I think, Emily, you wanted to add something.
I just wanted to add, we've done a lot of analysis on the energy security question. I think there's two components. There's energy transition, which is a slower, longer-term drive towards net zero, and there's the energy security. So when we look at removing Russian gas from Europe, for example, that requires every single piece of slack in the entire global energy chain to come into play. Coal is one part of that, and that's what twigged with me, is that yes, we have seen some European countries going back a little bit towards coal power generation, which is obviously a step backwards in terms of the green goals, but it does tick, at least briefly, the box on energy security. The other fuel we haven't really mentioned yet is LNG. And obviously we're talking about removing investment in oil and gas. LNG, I think, is still an extremely critical part of the energy transition. It's going to be required in order to cushion as much of the price blow from removing Russian gas, along with all the components we've already mentioned, so increased use of renewables, biomethane, green hydrogen, looking at potentially some pipeline gas coming in from Algeria and from Norway, some domestic supply as well. But the LNG component is very interesting. It is a lower carbon fuel, so it does tick a transition box as well. It will require Europe to outcompete Asia for cargoes, which means looking for a high price. We're already seeing a lot of US cargoes making their way to Europe. A lot of LNG contracts are long-term. I think something like 71% of Qatar's 2022 cargoes are already under contract. So either they will have to be broken or there will be a serious price component to that. And it also depends on how much demand for Russian gas moves towards Asia. You could end up with Australian LNG cargoes making their way over to Europe. We'd have to see a large build out in infrastructure and capacity within Europe as well. That comes into the cost of the energy transition. I think it's interesting that we're looking at an immediate energy security situation, but longer term, whilst LNG I think will be a critical fuel, it is still a carbon. It's still a hydrocarbon, sorry, within the energy mix. So over time, renewables will also see a change in behaviour. Some of that will be government mandated. There will be potentially, if prices go high enough, days where you're not allowed to drive your car if it has a certain letter in the number plate, for example, or everybody being told to turn their thermostat down by 1 degree or 2 degrees. And then there will be just a general distaste when we see the price at the pump and people will say, well, maybe I'm not going to do that. Maybe I'm going to buy a bike and get to work like that. But I just wanted to mention that coal in the near term is still, and will play a slightly larger role, but hopefully it's only a short-term band-aid over the situation. But LNG, I think, is a really important fuel.
Thank you. We've talked a fair amount about Europe. Actually, a question came in on emerging markets, and I thought, Yelan, since you are not the only one, but an emerging market expert, I'd ask this question to you. So it's really quite simple. It's which regions which countries in emerging markets have made the most progress in this energy transition.
Interesting enough, we've seen some countries, even within European Union, quite advanced. And, Hungary was in the headlines, caught up in headlines asking for 18 billion from European Union in order to transition from Russian oil. But I think Hungary has done a lot of good work in terms of energy transition. So I think they've done a remarkable job there. Of course, caveat here is, of course, that they can use nuclear. So I think this is something that is a very patchy question in terms of transition. We didn't really talk about it at Germany's position or Japan's position in terms of acceptability of nuclear as a fuel of the future. Interesting enough, countries in need, the ones that are large energy importers, and I think Turkey comes to mind, which has really in a very fascinating manner, they have switched over a decade. They transitioned to 30% of their energy being renewable, so very, very fast. So I think we're looking at opportunities, interestingly enough, also from some countries which have already secured a significant amount of hydrocarbons in the past, but still also moving on and embracing that agenda. We can talk about even a country like Saudi Arabia, which is a significant, significant project in hydrogen, 200 billion project that I'm sure a lot of bankers, including yours, asset managers are looking at those opportunities. So there are opportunities there. And of course, the biggest expectations for us would be still for those countries which are still quite heavy on coal. I mean, as Emily was discussing that earlier, in China, India, so faster transition there, which China has started really putting together a coherent plan in a reduction, phasing out coal, but it's arguably this year has not been a significant year of that reduction, but they have plans. So I think we have hopes for those countries that are going to make a huge impact in terms of the climate math, especially those large countries that I mentioned, like India, which has a significant manufacturing build-up that needs really to be addressed from the climate perspective.
Thank you. Certainly opportunities to be found if you know where to look by the sounds of it. You will all have noticed, also for you dialing in virtually, that we do actually not have an oil and gas company on this panel today, not for lack of trying. They were busy with many other events that are kind of booming again, going on around the world. But Ben, I just thought maybe you could provide us a perspective here, because I always ask you the tough questions. So I read a lot in the papers that oil companies, major oil companies, they are kind of claiming to really be embracing this transition to net zero, when in fact, often the words don't seem to match the actions. You hear greenwashing, that we're all very familiar with. So what is your take on that? Are companies doing enough? Could there more be done? Is there a difference whether they're small or big? Tell us more.
Just before I answer that question, I'm going to add one point to the last remark about which countries are doing a lot. I think there's always just a bit of a danger to assume that the OECD world is ahead of the emerging markets world, and that's not necessarily the case. I spent first half this week in Zambia, which has circa 80% of its power base renewable, driven by a massive hydroelectric dam. Now, I appreciate there's a lot of ESG issues with hydroelectric build-out, but I think it's just DRC just north, which has got all sorts of complications. Again, a huge renewable power base. So I just think when we're thinking about winners and losers in sort of the base case of the transition, we should just be mindful that it's not always OECD wins. Anyway, moving on to sort of second point. Oil and gas companies doing enough? Big question. If you listen to CEOs at investor presentations of the super majors, they probably spend 50% of their time talking about their renewables business, 50% of the time their traditional up and downstream business. Yet, if you look at where the investment dollars are going, and certainly if you look at where revenues come from, the numbers look very different. So I think your first answer is probably, you'd be drawn from that to think maybe not. That said, I think too often we focus just on the supply side and put too much responsibility on the supply side. That's almost my point from my first response was, the demand is so strong for oil and gas that you couldn't just switch off the pumps. It just doesn't work. And it's not just your cars or your airplanes. There's a massive chemicals demand. The use for hydrocarbons is far broader than is often portrayed in the press. So I don't think we should just assume the oil and gas are just the bad guys and are intentionally sort of actively greenwashing. I don't think that's the case in any capacity. They are investing, and I think what's been quite interesting is the development of a renewable business within an oil and gas franchise has inherent challenges. Renewable power is effectively a utility. It's got a totally different economic model and risk profile than doing massive exploration projects. So it's taken time. Again, the reward that you get from a successful oil and gas project, I think, Emily, you can correct me if I'm wrong, but Brent was north of 110 today. The sort of the returns that you can get from oil and gas project or traditional oil and gas project are still so much higher than the renewables piece that I don't think it would make sense for oil and gas companies, certainly with the demand side, to stop doing oil and gas. So I think the sort of the conclusion to your question is what we want to see more of is them using the upside from their traditional business to take on more projects, take on more transition projects, be real sort of leaders in the renewable sector, be real leaders in the development of new energy sources, whether that's hydrogen, ammonia, etc. And I think that's the really big ask. And I think sort of the topic today is how are geopolitical events impacting? I think there's a real sort of onus, and I haven't seen this happen, but I think there's a real onus on both the investor, bank, and oil and gas market is not to use geopolitical events to sort of delay transition or delay investment into transition, saying, oh, it's too difficult, sort of energy security trumps net zero. So I don't think it does. I think we need to be doing both concurrently. So to wrap up, are they doing enough? Probably not quite. And actually, I'm going to just add in one sort of final remark. I've sort of focused pretty heavily on the super majors, so the BPs and the Shells. There is this whole E&P world, and then also the national oil companies. And I think that the onus there is I think there's probably a criticality for them to engage a little bit more. A lot of E&P companies rely on international bank funding. We are not the only bank who's made a net zero commitment. I've looked at a large number of E&P companies. The majority of their banking group have net zero commitments and will be looking at the emissions intensity. I'm sure it's the same for my two investor colleagues. Emissions intensity of their respective investments, and things like routine flaring, things like sort of drilling in sort of really sort of low API fields. We just need to stop doing that. And I think if they are to, or if right the way through the sphere of oil and gas sector, if access to capital is to remain not in the next sort of 3 to 5 years, I think geopolitical events sort of give everyone a bit of a pass, but out sort of 10, 15 years, certainly as we get nearer to 2030 when a lot of financial institutions' targets bite, I think we need to be seeing more than just a credible policy, but tangible actions right the way through the let's call it a food chain of oil and gas companies.
Thank you. You briefly mentioned hydrocarbons in your answer, and Yerlan, is that really the future of energy transition? What are you doing to really support hydrocarbons?
No, I think it's a very tricky question. Yes, in a short period of time, I would definitely agree with Ben, is that we have to work with those companies. We have to invest in those companies. But the way that we do it, for example, we have the energy transition scores that we attribute to all these companies, and we try to engage with them, and we try to choose those companies and invest in those companies which have relatively higher scores that are reflecting better plans, if you want, and better execution of the transition plans. So I think I would agree that at the moment we don't see that it's possible for us to stop funding fossil fuels altogether. Of course, we have very strict policies similar to Charles, as Charles mentioned, towards coal. We think this is, should be really an exemption maybe this year, but then we have to really see other solutions. Gas is obviously less pollutive, and therefore we're more in favor of that against coal. But altogether, I think there will be a transition period away from hydrocarbons that we should, as investors, foster. So the future, I think, is impossible for now. I mean, depending on your time horizon. I think if we think about next, 100 years, probably we still will be consuming to a certain extent the hydrocarbons, but to a lesser and lesser extent, if we really want to fulfill our dream about climate change.
Thank you. We have an interesting question from someone in the room here, and it's around the current oil and gas prices and whether they will actually accelerate the move towards the energy driven. What's your take?
I'd say prices elevated as they are. If we were not in a conflict situation with Ukraine and Russia, we imagine oil prices should be under $100 a barrel at the moment. So there's definitely, say, $15 or so priced in as an addition to that. I was just thinking to what you were saying about transition, and it's quite clear to me that the transition will be forced through reduced supply. Demand will stay very high. In fact, in our models, we estimate demand's about 98 million barrels a day at the moment. So it's obviously slightly lower because of the situation with COVID in China and the lockdowns there, and that's taken quite a large chunk out of the demand picture. But when we forecast our supply-demand balances going forward, by 2025, we've got those numbers still increasing, and that goes up by another 7 million barrels a day to about 105 million barrels a day. I can't see a situation where demand is at 105, supply is being curtailed by this lack of investment, that capital moving away from the industry, and then obviously oil and gas being then a declining industry. I can't see a situation where prices are significantly higher than they are now. And it's that significantly higher price that is going to, in time, affect demand and bring those numbers down. So I think the energy transition will cut the supply side before it cuts the demand side. So yeah, in terms of prices, that they've got to be higher. Obviously, there's always demand destruction when we see high prices. They come off as a natural balance. So I spoke to my trading team this morning about it, and they said they didn't see any reason why we shouldn't be at 130, at least in the near term. We've been playing, we've called it headline roulette at the moment with news coming out of the Ukraine, with country-by-country statements about energy security, with news that this pipeline has been closed off or this country is unable to have any gas offtake, and there's been huge movements on the back of that at the moment. So volatility is my word of the moment. $19 Brent move in a day is absolutely extraordinary. So yes, I see no reason why prices should not be higher. We would prefer them to be a little bit lower. We think that the fundamentals support a lower price. However, although we see there being enough supply for demand at the moment, that doesn't necessarily mean that the oil is, or the gas is in the right location. So it's those dislocations that have driven prices higher.
Thank you. I have another emerging market question, and I think, Charles, if you wouldn't mind, I bring you in here. It's actually, we had an interesting panel just earlier that talked about this, but maybe not everyone here in the room or dialed in actually heard us talk about it. So the question is around when and how emerging markets will be able to really monetize the large carbon credit endowment. It talks about rainforests, in Latin America, in Asia. So when will they be able to monetize all of that?
Well, that's a very difficult question. Look, the challenges emerging markets have when it comes to energy supply in general is the fact that for a lot of them, they are the energy assets are state-owned, and so the way this is run, whether we all have in mind, Eskom in South Africa, Petrobras in Brazil, Pemex, etc., makes the governance and the decision making highly influenced by political matters. So I'm not trying not to answer your question, but obviously will be case by case, but it will be highly driven by who's running the country at that particular moment, which we all know in EM can be hugely volatile. And sometimes it's a bit counterintuitive. I think Yerlan mentioned Turkey. You know, in Turkey, they've done a great job at increasing this renewable share of the energy mix, where on the other side, they may have done things differently. So it really depends where you know, which country you're talking about. For the quasi-sovereigns, this is where, for us, engagement is the toughest part. You know, trying to engage with governments or state-owned companies, majority-owned companies by the government, where we feel we need a joint effort, clearly, as investors. I mean, unless you are, I'm not going to name some of our peers, but unless you are invested in absolutely everything and you are huge, you need other investors to team up. And this is where actually we've made progress on the climate action plus initiative, or when we team up, and yeah.
Yerlan, I think you wanted to add.
I just wanted to add to what Charles said, is that I think we need cooperation to really create mechanisms of monetization, if you want. So, you know, we need cooperation from the banks as well, so we can create the market for the carbon trading in emerging markets. So I know, you know, there are a lot of discussions and question marks about deforestation generally, or some countries are trying to stop the deforestation, and whether the credits from the reforestation can be also accepted in the same way as we have now created the European, you know, if you want, industrial carbon credit. But the reality is that there are already good examples, like Colombia, where we have actually a fungibility of both industrial carbon credits and reforestation. No? Maybe it's a blip, maybe not, but the reality is that we need to use those examples where we could really create fungibility of some of these. Big question, of course, that especially around when you're saying, you know, reforestation and these credits, which are not really coming from the capturing, but really in terms of the carbon sink, and there are a lot of countries in emerging markets which could provide this carbon sink. The fundamental issue and fundamental question is, at what point, you know, you think that these are irreversible carbon credits, because we know that, you know, sometimes we have the release of the carbons even from those forests that we actually have created, and at some point that becomes an issue where we're actually quite quickly burning those carbon credits that we have already traded. So I think this is something that we need to incorporate in the way that we think about carbon markets, but I think in emerging markets is a very nascent and very interesting opportunity, I think, for the banks like Standard Chartered as well.
Very briefly, Ben, you wanted to add?
Well, I was just going to sort of almost respond to that, just to the extent no one in the room's aware. So I think at Standard Chartered we're playing a really active role in the development of the carbon markets, certainly the voluntary carbon market space through our role on the Integrity Council. And then just to pick up on one of Emily's points, I think there is, and almost it's a furthering of Emily's, your earlier question to me around, is the oil and gas industry doing enough? It feels there's an opportunity at $100+ oil, at the end of the year or episodically through the year, the oil and gas clients are going to be sitting on a lot of cash. What are they going to do with that cash? Is it just a straight dividend payment out, or is this the time for the sector to actually think, right, something like the carbon market, I'm going to commit to this, I'm going to commit X number of $1 million to act as a lead off-taker. And I think as more players start to make meaningful commitments, you obviously need the integrity component to be there, but a marketplace forms. I think it is pretty exciting. This is a carbon as an asset class. It's now very well established in the compliance sense, but the establishment of a voluntary carbon market is, I think, is necessary, and I think we'll see a lot of progress, or hopefully see a lot of progress in the coming 18 months.
Thank you. We have another very interesting audience question that has just come in, and I think our asset managers on the panel are very much in demand because it is has to do with how you keep investors interested. The person mentioned that very few funds with ESG mandates have actually outperformed the S&P 500 this year. So what is the deal? I mean, will that derail the transition because you can't get enough investors interested, or is this something you're not seeing at all? Ben, for you, or Yerlan?
So I'll go quickly first. So I think that's one side of the story, but if you read Larry Fink's September sort of CEO letter, his narrative for the future unicorns of the world were very much aligned to decarbonisation tech. So I think maybe the sort of the ESG fund today is a little bit too narrow. It's focusing on renewable power, which is largely a utility. So I think the returns, I mean, very generalist there, but I think the return scope there is much lower. But if we are to meaningfully solve or make credible carbon reduction targets and get nearer to a 1.5 degree alignment, the technology play here is massive. And I think the valuation piece of the potential valuation of the technology that solves is far greater than potentially even the oil and gas sector today.
Thank you. Charles, anything to add? Or do you see, how is fund performance?
Look, on the sustainable EM corporate bond fund, it's done well year to date. And it's counterintuitive because we exclude oil and gas. Maybe in EM, I must say it's also counterintuitive because some countries actually that are net oil exporter are being impacted so much by inflationary pressure on food and other sectors that is offsetting, the benefit in some countries. But it is possible to have a decent performance without being invested in oil and gas. So that's from a pure performance from facts, numbers. Like I said, I think in the short term, we are expecting, market participants to be long in oil and gas for the reasons we all discussed. I'm still sticking to my point on the medium to long term trends where I'm actually worried about the small and medium scale oil and gas companies coming to the public bond market, in particular in emerging markets. I'm thinking this shift of capital out of oil and gas, forced or intended, it's going to make those small and mid-scale companies in a bad place in 3-4 years when it comes to refinancing. Yes, oil price may be high and the levered free cash flow break-even may still be much lower than the actual oil price, and they may be continuing to generate free cash flow. But if you can't refinance because no one wants to fund you, how is this viable as a business? So from an investor standpoint, we are extremely cautious. I mean, there is the rate, rates are not helping as well. But if you are, in West Africa that you know very well, Ben, there is, you can't pay 100 basis points in terms of credit spreads, even if you generate a lot of free cash flow. So if rates are at, 5, 6, who knows, in 3-4 years, then you're going to have to pay, north 9%. And how is the business model viable at this stage? So we are cautious. I'm not saying that the large oil and gas companies won't be able to fund themselves in 5 years, but I think it is something we need, as a long-term investor, it's an important thing to bear in mind.
Thank you. I had a last question prepared for you because to wrap it up, I know we're running out of time, but actually something equally interesting came in from the audience. I'm just going to throw it at you since we're at the end of the day and drinks are awaiting us. It's in the same way in what I had prepared, but I thought it was really interesting. The question is, if we had the same panel discussion in 10 years, what would we be discussing today? Yerlan, would you like to go first?
Yes, of course. I think what is really necessary for us to engage with companies, and they have made all these commitments on net zero, on energy transition. And we started to sometimes take their word for it, but we need to really constantly go back and check where they are. And really, in 10 years' time, we will look back and say, okay, this was the promise from the industry, this was the promise from these companies we invest in, and how we're going to address those changes. So I think this is one. Second, of course, on the regulatory side, we're going to probably go back and think about what this new regulation that is coming through with the MiFID II amendments dealing with SFDR disclosure and minimum levels of sustainable investments. When, I think by then we will have a very good picture whether this really affected the desired transition of the funding from the industry perspective into the sustainable companies, and how far we are from reaching that target of net zero, because in 10 years it will be 2032, we already will be past 2030 first benchmark, but we'll be much closer to 2050. So I think this will be the moment for us to discuss what we achieved in the past.
Thank you. Very briefly, Emily, what do you think?
Really caught me on that one. I was just thinking, my job title is energy analyst. Would I still be an energy analyst? I think I would, but maybe there would be less discussion on oil and gas. I don't want to be a utilities analyst. Steer away from that. I wonder if we would still be having the peak oil demand, peak oil supply conversation that we've had for the past few years. In 10 years' time, maybe oil demand is somehow still going up. Maybe it's not, but that's a really difficult one. Yeah, hopefully I'd still be in the job. That's all I'm saying.
Let's all hope. Charles, what about you? Very briefly.
We'll probably discuss about everything wrong we say today. Think about 10 years ago. I mean, in 2014, was that June 2014 when oil price went to the roof? I mean, no one expected it. So, no, joking aside, like in 10 years, I think we're going to talk probably even more about EM. It's going to get bigger. This is a trend, and probably EMs will be more important in 10 years versus developed markets than in today's discussion. And the final point, we're probably going to talk about other topics than oil and gas when it comes to climate change, etc., like, animal welfare, protein production, which I think is a big thing in sustainability. So, yeah.
Very briefly, you have 30 seconds.
Full rebrand of the sector, mass demergers of assets within oil and gas, and expansion into new minerals.
Thank you very much. This leaves me to thank our fantastic panelists for a really, really interesting conversation. Before we end, I would actually like to welcome our host of today, Henrik Graber, Global Head of Credit Markets at Standard Chartered, back up on stage, and he would like to say a few closing words.
Thank you, and what a great final question to end the conference on, where we'll be in 10 years from today. And I really also like the thought about emerging markets being even bigger when we are today. Thank you for a very eventful and informative day. When we started this a few months ago to start a hybrid dual conference on the same day, we did have some concerns how it all come together. We had a fantastic session in Dubai this morning, segueing into London, and I think overall we learned a lot and covered some really topical issues. We chose the topic of riding the wave, and we had the first panel on watershed moments, and throughout the day and across the two panels tackled many of the subject matters that our issuers and investors are facing currently. And we are in quite a different period than we've been in the last 10 years. We have a lot of growth opportunities across the panels. There was more positive members, and there were those with slightly more concerning outlooks. But I think overall, over the next decade, we will see a lot of opportunities and growth, and in particularly in the emerging markets and in the areas we talked about, such as private equity, ESG, or sovereigns, and so forth. We are upbeat on some of our markets, in particular India, China. You heard some of the thoughts around that, and we expect recovery also on the back of the pandemic easing. Finally, I would like to close up by thanking the fantastic panelists and moderator we've had today across both London and Dubai. Obviously, the physical audience is great for everyone to be together in the room, and the many, many individuals that attended virtually. I would also like to thank you for the fantastic organization and the production team that put the whole conference together. And I very much look forward to spending some time and having some drinks, which are right outside. And again, thank you for attending the GCM conference of 2022.